Hello and welcome to the download. I'm your host, Dave Richardson, and we are joined by someone that I am really upset with. And David Lambert, head of European Equities at RBC Global Asset Management. Do you know why I'm so upset with you?
I don't, which makes me slightly nervous.
So I rely on you
Okay.
for recommendations, particularly around puff pastries filled with delicious meats. And I'm watching CNBC, and
Okay.
they're telling me about a profit warning at Greg's, which is apparently a bakery chain in the UK, known for, and the profit warning is because you're having a heat wave there, and so nobody's buying baked goods, particularly sausage rolls, because they're not very good for you anyways, which is why I look like this. And you have never mentioned Greg's sausage rolls to me. I should have heard that from you years ago. Very disappointing.
There is a reason, Dave, and that's because they aren't as good as the ginger pigs. Apparently, their vegan sausage rolls are very good. But it is really
Ah,
interesting what happened to Greg's because, it was a summer heat wave, so people don't eat
yeah,
sausages. Now, so I'm going to go straight into a story here because one of our stocks,
sure.
Unilever, they own the brand Walls. Now, Walls was formed in the 18th century, and they were a sausage company. And what they realized after about 150 years is that they had to lay off staff in the summer because they couldn't sell sausages. So they came up with an idea of creating ice cream to offset, so they didn't have to lay off staff. So in the early 20th century, about 1910, they set up an ice cream company to complement the sausage company. So Wall's sausages still exist, but Wall's as an ice cream brand is owned by Unilever, which is one of the biggest ice cream owners globally. So Wall's ice cream came about because of this very example you just gave, because Greg's are experiencing a hot summer. So it's swings and roundabouts, and I just thought I'd bring a story to you.
Really? So then I'm taking it. So you say you Unilever's been a holding of
Yes,
yours in your portfolio. I'm taking it Greg's has not.
correct. Greg's hasn't, but actually, from a return profile, Greg's looks quite interesting. But you have to be aware from a valuation standpoint on the cyclicality and the potential cyclicality of businesses, which is why we have a great analytical team behind us looking at these things, and we don't own it. But actually, in this past couple of weeks, we've talked about it as a team, and we've been looking at it because it's actually a pretty good business. And
Yeah.
if the valuation comes down and takes into account that potential cyclicality, then actually it could be something that we could see in the portfolios. But a lot more work to be done. But these things, we talk about them as stories and funny stories, but there's always tangents to what we own in the portfolio and what we're actually looking at as potential ideas going forwards.
Well, I think to make it up to me, you need to invite me on the company visit, and I'll sample some of the products, and I can be that part of the analytics team because I'm pretty good in it. One of our colleagues that our global team sent me on to a chocolate company meeting for analyst meeting. That was pretty good. That was pretty good.
It's called primary research.
Primary research, excellent. So I can at least do that. Well, hey, we great story to start stuff off, but maybe the best story has been something that we've been talking about for a while, which is at some point the world is going to recognize the value in European markets, and at some point Europe is going to start to deliver performance at, or maybe even, oh God forbid, above American or US stock performance. And lo and behold, that's the first half of 2025. So what do you think was the trigger, and what's happening over there that makes it such an exciting market for capital to flow?
Well, the main trigger we saw, and it was definitely through the first 3 months of 2025, was particularly what came out of Germany and the infrastructure and fiscal spend that they'd committed to. And they've carried on committed to. And in fact, they've even committed to spending 27 billion second half of this year. So the 500 billion of infrastructure spend that Germany was talking about, has really already gone through government and been passed into legislation.
Yeah.
So we can see it, we can touch it almost. And I think that was the real big thing, because the thing that Europe's always struggled with as a domestic play has been that sort of growth angle. And now, if we think about defense spend, infrastructure spend, stimulus that we haven't seen for a long, long time, for decades, is now coming to pass. So when you think about how you build your models and you think about what do I put in for that G for growth into the calculations going forwards, well, instead of it being 0 to 1%, then maybe it's 1 to 2% or even higher. And that sort of incremental upgrade is actually very significant. One, in terms of a valuation perspective, because things that grow faster at higher returns should be valued higher, but also from an earnings growth perspective going forward. So you've got that double kicker. So what we saw the first half of the year was, earnings, its valuations from a very low level start to re-rate slightly.
Yeah.
Not getting anywhere near where the US is.
Sure.
But ultimately, the second leg is, so probably if we look at valuations now, they're sort of at median levels, what we've seen over the last 20 years. Now, obviously, that's from a low growth era and from a low return era. So one would say sort of in a long-term basis, maybe they're artificially low. So actually, you could see some closure with respect to the US. But on top of that, the actual growth perspective looking forwards actually looks a lot rosier. Because in the past, we've relied a lot from earnings growth for European corporates coming from international markets, from North America, from emerging markets. And, and I always say this, I think of Europe as 40% Europe from revenue exposure, 30% EM, 30% US. And that 40% of Europe hadn't been doing a lot. Now, if we look forward, that 40% Europe exposure might be doing a little bit more than it used to. And from a valuation perspective, that could mean higher valuations for Europe, but definitely means higher earnings growth for Europe. So if we get a double kicker of higher valuations and higher earnings growth, it could mean that Europe performs very nicely. And that's definitely what we saw the first half of the year.
Yeah.
A re-rating. Earnings growth itself was on par with the US, for instance. But you see then what happens is if you've got an asset class on a very low valuation, and you only have to start to close that very slightly, and you see a huge amount of catch up from a performance perspective, a huge flow perspective. We've seen lots of flows into European equities and international markets this first half of the year. So it's very powerful when you get this sort of, virtuous cycle of things happening. So, it's been a very good start to the year. We've tracked sideways, really, for the last 8 weeks to 12 weeks or so. But, we've moved a long way very quickly. And sometimes you need digestion within a market to sort of get its feet again and rebase, and then going forward to rally off a sort of a lower earnings base or a lower earnings base with lowered expectations. So, the outlook is still fairly rosy, I would say, for Europe, and very differentiated to what we've seen over the last 20 odd years.
And so when you look at in terms of the benchmark that you would use to evaluate what the multiple is on earnings, what would that benchmark be, and what is that running? The US is running what, about 22, 23 times earnings right now. So where would Europe be sitting?
So Europe right now, going into the turn of the year, we were looking at sort of 12 times earnings.
Yeah.
But now we're at about 14 times earnings, which, is a re-rating, but nothing like the 22 times.
Sure.
So, if you think of an asset, even think of a stock, something that can grow at a decent rate on higher returns, 14 times is a fairly low multiple. So 14 times, which is in line with the sort of what we've seen over the last 20 years. But one would argue over the last 20 years, we've been through sort of, bank crises, migrant crises, a lot of things in Europe. And maybe we're just coming out the other side with a stronger banking sector, with a higher growth profile, with more fiscal stimulus coming in. So, one could argue that re-rating could go further. So we're kind of back to normalized levels, but still far behind on a relative basis to the US.
Yeah, and that's just something which a great lesson for everyone listening to the podcast. And again, we've had David on several times over the years. We usually catch up with him about once a quarter, and we have just been talking about the underperformance of Europe for a number of years, but at the same time talking about that valuation point. And you need to, so the story that Dave's telling is like, look, we've got similar earnings growth, or at least earnings growth that's in the neighborhood, and then we've got the potential for fiscal spending, whereas in the U.S. debt's tough, and debt levels are high. So why would I pay somebody $23 for a dollar of earnings when I can buy something for 14 times? And you start to just say, well, that gap, if the growth in the U.S. and the potential in the U.S. is that much higher, well then yeah, maybe I will pay more for it. But all of a sudden you get that shift, and that 14 times becomes, or 12 at the start of the year, becomes really interesting. Because I just right, like just you just got to say like, hey, why would I pay more when I can get something pretty good at that kind of discount?
Exactly. And we're not talking about shifting all of that stuff in 22
Sure.
times the market to
Yeah.
to Europe. But it just goes to show, and we've always talked about this, that diversification in an asset class that moves in a differently. There are correlations, but there are different movements within the market at a cheaper valuation. You see in periods of a cycle, and we think there'll be more opportunities in this cycle, given what we've said with the fiscal stimulus. It pays to own these assets to diversify yourself and protect yourself from downdrafts, from higher valuation parts of the market, etc. So, it's very, for us, it's a very important part of a sort of a global makeup of asset classes and geographies.
And David, we're talking primarily to Canadian investors on this podcast, as
Yep.
you know, and on top of just the performance of the market, we've also seen the euro relative to the Canadian dollar pick up about 10% over the last 12 months. So that adds on to your return because you send your money over to David, he invests it at in euros. Or pounds, because pounds had the similar run, and then if you sell, God forbid you do that, but you sell David's investments and you bring it back to Canada. You're buying cheaper Canadian dollars, so you get a little bit of a kicker on your return as well.
Absolutely. And I mean, the current CEO, Dan Mitchell from Dev Morris team's over here this week. And we were chatting this week and talking about sort of currency hedging and the way currencies are moving. And the currency team can articulate much better than me, but, talking about a weaker US dollar for longer. So that's right. So as an asset class, Europe fits the bill in terms of what's happening at an idiosyncratic level, but also from a currency level. I mean, clearly you have to then, as a portfolio manager, have to look at the exposures of exporters to stronger currencies.
Yes.
and what that does to the earnings, etc. But that's part of our job. Do they have hedging in place? How are they offsetting costs with revenues? But that's part and parcel of the day job of what we do. But all those things. But absolutely, the stronger currency, again, something we haven't seen for a considerable period of time. Euro, sterling. Also, the Swiss franc. The Swiss franc's been super strong, and Switzerland's a decent chunk of Europe as well.
Yeah, and what you'll typically see just for Canadian investors is when the U.S. dollar gets weak, we pick up ground with our Canadian dollar, but the Canadian dollar tends to be linked more closely to the U.S. dollar. So then you go over and you look at some of these other currencies like the euro, like the pound, like the Swiss franc. They tend to get a little bit more lift relative to the Canadian dollar. So again, that's where currency comes into play. And currency over the long term is almost a zero-sum game, but in the near term can have a significant impact on the returns that you're getting when you're investing money outside of Canada as a Canadian investor.
Absolutely. But I think the one thing to highlight with our products is that when we look at our products from a benchmark perspective, the currency exposure is hedged back to the benchmark. So for instance, say we're underweight Switzerland, we're underweight Swiss stocks, we won't be underweight the Swiss franc. So we're not taking a view on the currency. And that's quite important to make clear. We're not doing, so you're not taking those exposures. Right. It's all benchmark.
Yeah, very good. So David, let's talk about Europe and the tariffs. The tariffs have popped up again this week. Well, they've kind of been around every week, but it seems to have accelerated a little bit this week with some letters going out and some additional tariffs on copper and some other things. And how have European markets performed through the different levels of scare or the different intensity of the tariff scare since the Trump inauguration, and where do you think we sit now with tariffs?
Yeah, well, I think the degree of volatility we've seen in the markets has subsided. So the markets have become much more resistant to the noise. Now, clearly today, as we talk, we've had a letter go out to Brazil last night, and so anything with Brazilian exposure, is a little bit wobblier today. But ultimately, what this does makes it very hard for companies to plan for their capex and to plan for their business going forward. So that's not a good thing, but that's planning for their businesses in the US in essence. But as I say, the market has become more resilient. So I would think of this as, your risk premium goes up slightly because there's that degree of known unknowns that is going to persist, guaranteed for the next sort of 18 months. Whether it's hot air or whether it's real and comes to pass, and not a lot has come to pass at the moment. But when we draw it back to the companies themselves and how does this really impact them, it really is fairly small from a revenue exposure, from a European equity perspective, in terms of things that are made outside of the US and sold in. A lot of these global businesses that we invest in have their manufacturing already in the US. There's very little. You can look at areas of luxury and spirits, etc., which are made outside and then shipped in. But ultimately, when you look at the actual impact of tariffs, it's fairly minimal. The real impact is on that risk premium, which affects the whole of the globe and all global equity markets. But as I say, the volatility to those headlines has dampened considerably, over the last sort of 6 months or so.
Yeah, and not overly surprising that that the markets get more comfortable with it. When you're out talking to companies, because we did touch on the idea that you do go out and you do that primary research, along with all the technical and fundamental and all the analytics that you follow. When you're out are you seeing any differences in the way management teams are managing through this tariff uncertainty, and does that trigger you to take a closer look at some of these companies that you're really impressed with the way they're thinking about it?
Yeah, well, I think there's a couple of things. I think one, these global companies, have this ability to allocate capital to where they have more certainty, to where they have higher returns or they see growth opportunities. So actually, a lot of European companies, probably one of the most globally exposed market in the world from a revenue perspective, have that ability. So actually they can sort of sidestep. So I think that's a real advantage. Now, a lot of companies I expected going into the most recent sets of results to sort of rein back on their guidance and sort of use that excuse of uncertainty as a reason to sort of give you less clarity on how they see their business. Actually, we haven't seen as much as that as we thought, which is a positive because it means companies are still very comfortable in how they're seeing things, how they see the trajectory of their budgeting for revenues, for costs, et cetera, et cetera. So it's a couple of things. I think I've been pleasantly surprised how resilient companies have been. And secondly, the companies we invest in typically have that ability to shift capital away if things get so bad. But as it happens over the last sort of 12 months or so, because what we've been seeing in Europe, we've shifted the portfolios. We still have lots of great global businesses, but our exposure to some more domestic businesses has increased slightly. I think about utilities, we think about banks, we've talked about, think about telecoms, typically purely domestic businesses. And our exposures have drifted up there relative to where they've been over the last 10, even 15 years.
And so are those the areas that have been leading the way, David? Or what areas have been leading the way in Europe? And then as you start to look in the second half of the year, does that leadership continue? Does everything remain in place to hold that leadership, or do we start to see things shifting around a little bit?
Yeah, I think that's an interesting question. I think the bricks and mortar are in place for banks and defense companies to still continue to lead. So that's what's been leading this first half of the year. Now, defense, for obvious reasons. Now, there's a differential here. Defense now is re-rated quite considerably, but the growth outlook or the profile going forwards, there's more certainty. There's definitely more demand. So actually, it's an interesting space. I expect it will still be leading, but not to the extent it has been so far. We've seen the majority of the re-rating. As it stands, we have a decent position in aerospace and defense, and I'm quite happy with that. Banks is the other area that's led, and we've talked about banks for a long time on these podcasts. And it's really interesting what's happening with banks now. We saw banks sort of sort out their balance sheets on low valuations, tough regulations, and have performed very well. Started giving cash back to shareholders, and have performed very well, and have led. And this week have hit 9-year relative highs in Europe. So they've been super, super strong. But I was telling one of our internal meetings earlier this week that what we've actually seen in more recent statistics is loan growth within Europe, which has been 0 to negative since the financial crisis, was at 2% year over year at the last reading, which is not a huge number, but it's pretty significant. So if you've got banks now operating in a region which is now seeing loan growth, when we do our equations and we think about valuations, there's a value to that G, there's a value to growth. you've got a second leg to why banks could continue to perform well from from tough regulatory position, but that's fine. They've dealt with that from good balance sheets and low valuation. So we'd expect banks to continue to do very well. Defense will be fine, but has done the majority of the heavy lifting with the re-rating's been done. And I mean, the interesting aspect, so it's been very pro-cyclical, the market. So defenses have lagged, healthcare's been terrible, staples have lagged, but there are some great businesses in these areas. Now, while the operational momentum and the price momentum remains, sluggish, we'd be reluctant to move in, but we are seeing valuation opportunities come up here in healthcare and staples in particular. So I think as we look at it going into the second half of the year, we'd expect more of the same, but we're being more attentive to what's going on from an estimates momentum perspective in these defensive names, because we're seeing, valuations looking fairly lowly in energy, healthcare, staples, those traditional defensive areas. Utilities, which is normally defensive, has actually been pretty robust. We still quite like utilities from that sort of electrification thematic that's going on. But yeah, so more of the same, but it's, as fund managers, you always have to be on your toes and looking for what's moving and why and what's driving it. So we're seeing opportunities arise in some of the quality areas of the market and some of the defensive areas of the market. Because actually the other aspect of what's been moving in Europe, because Europe's been in a sort of a recovery phase, quality names have actually lagged. So it's been the high risk, low quality names that have performed very well, which is kind of a tough market for us because we want to be invested in companies for a long period of time. We want to be in great businesses. So we're starting to see quality stabilize. And so that's what we're keeping an eye on. We're not forecasting a shift yet, but through to the second half of the year, that's what we've got our eye on in terms of good valuation opportunities to take advantage of. And these opportunities, these could be sort of 5-10 year opportunities we could be buying into.
Yeah, I read a couple of analyst reports from other firms this morning, both focused on that same idea that it's been surprising how quality's lagged in a lot of different places. So it's interesting that you're saying that what you're seeing particularly in Europe is some of these quality names that have very good shareholder value.
Yes.
In terms of returning capital to shareholders, share buyback, those sorts of things have lagged, and I know that's right in your bailiwick.
Yeah, absolutely. I mean, that's the sort of investment philosophy, almost in a nutshell, quality names that can compound themselves. But, we went through a period post-financial crisis where we had zero interest rates, where that quality trade was, it was a one-way street. Valuation's much more important in a more normalized interest rate environment. And that's what we've seen in the market. But typically in any market recovery, when you come off the bottom, that's what leads a rally. It's that low quality, it's the high indebtedness. It's those names you wouldn't want to be owning for a long time. But as portfolio managers, we have to manage that. But ultimately, we're looking for these opportunities now, and we can see them. And we're just waiting for the right time when we see the positive momentum sort of come about to invest in these for the longer term.
Yeah, and then the bank one is a very interesting one. I think the last time we were on, we were just talking about how much European banks have lagged since the global financial crisis. And when I'm talking about the global financial, we're going back to when, well, David and I were young men back then. That was 2007, 2008, 2009. And you're just seeing those banks get back to those values and move through that. And then, as you say, 2% loan growth, which doesn't sound particularly exciting. But maybe for Canadian banking sense in particular, but when you go from zero or negative to +2, wow, that's a move in the right direction, and that's when you start to see these stocks move, and if there's potential for more, that's what you're going to be able to tap into, and certainly where interest rates are sitting, and the way the yield curve looks, it's positive for banks.
That's right. And the thing we have to remember, Dave, as well, is that when we think about European equity markets, unlike US equity markets, financials are a big chunk. So, financials and banks are important. I mean, I'm not saying they're not important in the US, but tech's far more important than the US.
Sure.
When we think about US versus Europe, we always think about holding the European flag is the financials. So it's important that the financials, they have been behaving very well and continue to behave very well. And we expect that to continue.
Yeah, we're well aware of that and that concentration in financials as Canadians when we look at the
Yes.
at the Canadian market. So David, what are the big risks you'd be looking at over the horizon that could upset the positive momentum at least that you're seeing in Europe and the UK?
Yeah, I think that I mean the biggest risks are kind of the reversal of the things that have been working well. So if there's a delay in sort of the fiscal spend, which, as I said at the beginning of the chat here, we've seen Germany already commit 27 billion of the 500 billion to the second half of this year. So they've talked the talk, now they're walking the walk. So that's good. But any sort of dampening of that wouldn't be taken well. And obviously the defence spend, we want to see that continue, and that is going to continue. I guess we might see some peace dividends, and I'd love to see the peace dividend come through, just from a human perspective. But ultimately, that would disrupt some of the momentum trades we've seen in the market. But we're not overly exposed to those sort of those names. But I guess the biggest risk out there is what Trump does and what the decisions ultimately are on tariffs and trade and relationships between the US and Europe and China and the US and China and Europe, because they're very important. China's very important for Europe. I thought at the beginning of the year, China would be pushed more into Europe's arms with respect to, being more closely tied. I'm not sure if that's going to happen now, but they're the important thing. So any sort of blow up, and particularly with the trade agreement with the EU and the US, I think that's the most important thing. The Europe's trying to, toe a hard line with Trump. We see how that manifests itself. But ultimately, the way I would look at it, I wouldn't be too worried from a stock perspective. It's more from a risk premium perspective that that's going to impact things. So that's how I think about it. Other than that, you've got to look. My biggest worries would probably be more about the US. So our companies exposed to the US, do we see deterioration, slow down? How do we see, chances of recession, delinquencies, et cetera, et cetera? We'd be looking at things like that, but we're always looking for things like that. But that'd be the things at the top of my mind right now.
Yes, constantly paranoid and looking for risks. I think that's the
Yes.
that is just the life of a portfolio manager.
Yeah.
And I mean, one of the things I think that a professional portfolio manager tends to focus on and manage better than a typical investor. That recognition of risk and awareness of how to manage through different forms of risk within a portfolio.
Yeah, I think so. We've had the experience, we've been through many cycles, just sort of putting that to use. And that hamster wheel of work that we go through whenever we present, we try to articulate, how sort of it sounds mundane, but we're constantly going over everything we've looked at and checking we're right, or checking our assumptions are relatively correct, and then checking them again sort of constantly and having reminders. So that's the day-to-day job.
Well, I'm going to give you a tip. I think you should be looking at consumer stocks in Central Europe. My daughter is traveling through Germany, Austria, Slovenia, and Croatia. She has her parents' credit card, and we're already seeing the hits on the card. So there's people over there spending in that part of the world. So if you don't have exposure to that, you should probably get a piece of it. So and it's just great to see always, David. It's and great to see Europe winning. And
Yes.
also great that we were able to, for listeners, again, subscribe to the podcast wherever you listen to podcasts. Follow us on YouTube. Give us a nice review so that we move up the old algorithm and more people get to hear from David and the other guests that we have. Because if you'd been listening, you would have known that that Europe was a real opportunity, and it's great when we. It's always nice as when you're talking to investors and you say, hey, I think there's an opportunity here, and then it plays out. That I think that feels better than anything.
It does, but these things go both ways. So
Absolutely, we love. But no, I mean, ultimately, I guess what we're saying is we love it when Canadian investors are doing well
yes,
wherever they're investing, and that's and we're glad that Europe is playing out nicely as, again, a nice diversification play, nice currency play, interesting way to add to your portfolio.
yeah,
So yeah.
absolutely. That's completely it. As we've said all along, Dave, diversification. A decent asset class which has grown in sort of almost double-digit, percent compound. it needs to be part of the portfolio at some level.
Great. Well, David, thanks again, and we'll catch up with you in the fall probably. But thanks for always being there for us, and have enjoy the rest of your summer with the family.
You too. Thanks, Dave.
This recording has been provided by RBC Global Asset Management, Inc. for informational purposes only, and is not intended to be investment or financial advice. You should consult your own legal, accounting, tax, investment, or financial planning advisors before engaging in any transactions.